Okay, so you want to own a hotel. And honestly, the math looks incredible from the outside. You find a piece of land, you build a building, you put beds in the rooms, towels in the bathrooms, a coffee maker on the desk. And then, every single night, people pay you to sleep there. No inventory that expires, no product that goes out of style, no factory that breaks down. Just rooms, just people, just money arriving every morning when the night audit closes. In 2024, the average American hotel room sold for $157 a night. Multiply that across a 150-room property running at 70% occupancy, and you're looking at gross room revenue of over $6 million a year from one building that you own. So why are so many hotel owners quietly miserable? Why do some of the most experienced real estate investors in the country describe hotel ownership as the most operationally complex asset class you can touch? Why does one of the largest hotel ownership groups in America, a company that owns hundreds of properties, describe its own business as a constant battle against cost inflation, brand demands, and a distribution system we don't control? The answer isn't what you think it is. It's not location. It's not bad management. It's not even bad luck. It's the architecture of the business itself. The way money flows into a hotel and how many hands it passes through before it reaches the person who actually owns the building. That's what we're going to take apart today. Every layer, every fee, every hand in the pot. And by the end, you're going to understand why the smartest move in the hotel business has almost nothing to do with owning a hotel. Let's start with a number that should stop you cold. Hilton Hotels and Resorts is one of the most recognized hospitality brands on earth. Over 9,000 properties, more than 1 million rooms across 126 countries. A loyalty program, Hilton Honors, with 215 million members. Hilton owns 3% of those hotels. 3%. The other 97% are owned by private investors, real estate developers, pension funds, family offices, and individual operators who paid to build or buy the properties and then signed agreements giving Hilton the right to put its name on the sign. Marriott is the same. IHG is the same. Hyatt is the same. The brands you associate with the hotel industry, the names you search when you're booking a trip, own almost none of the real estate underneath their logos. What they own is something far more valuable and far more durable than real estate, but we'll get to that. First, let's talk about what it actually costs to get into this business. Say you want to open a Hampton Inn, mid-range, business traveler, free breakfast, you know the one. Hampton is a Hilton brand, sits comfortably in the mid-scale segment, and is one of the most consistently profitable brand flags in the industry. It's a logical starting point. To build a new 100-room Hampton Inn from scratch, in a mid-sized American city, you're looking at a total development cost somewhere between $15 million and $22 million. That number covers land acquisition, construction, furniture, fixtures, equipment, soft costs like architectural fees and permits, and the initial franchise application fee, which for Hampton runs approximately $75,000 to $100,000 just to begin the process. But maybe you don't want to build from scratch. Maybe you want to buy an existing hotel and convert it. In 2024, Hampton Inn properties near major American airports were trading at approximately $241,000 per room. A 150-room property at that price is $36 million before you've signed the purchase agreement. A 250-room property is $60 million before you've changed a single light bulb. And here is the first thing that shocks new hotel owners. The thing that experienced operators will tell you nobody warned them about clearly enough. The moment you take ownership of a branded hotel, the brand sends you a document. It's called a property improvement plan. In the industry, everyone calls it a PIP, pronounced exactly like it sounds. A PIP is a mandatory list of renovations and upgrades you are contractually required to complete within a specified time frame to bring the property up to the brand's current standards. New carpet, new furniture, new lobby design, updated signage, sometimes entirely new HVAC systems or plumbing. The brand standards evolve constantly, and every time a property changes hands, the clock resets. As of 2024, PIP costs have risen more than 30% above pre-pandemic levels, driven by construction inflation and supply chain disruptions that haven't fully resolved. For a mid-scale property, a PIP can run anywhere from $2 million to $8 million, depending on the property's condition and how far it's drifted from current brand standards. And here is the part that makes experienced real estate investors visibly uncomfortable. The PIP is not optional. If you refuse to complete the required renovations, the brand removes its flag. Your Hampton Inn stops being a Hampton Inn. The reservation system goes dark. The loyalty program stops directing bookings to your property. The sign comes down. And a hotel without a brand flag is not a business. It's a building with beds and no one to fill them. So before you have checked in a single guest under your ownership, you may have already spent $2 to $8 million more than the purchase price just to satisfy someone else's standards for a name you're renting, not owning. Let's say the PIP is done. Your 150-room hotel is open. Guests are arriving. Revenue is coming in. Here's exactly what happens to that revenue. The brand takes its cut first. Hilton's franchise agreement for Hampton Inn includes a royalty fee of 6% of gross room revenue. On top of that, there's a program services fee, which covers the loyalty program, the reservation system, and marketing. That adds another 4%. So before you pay a single employee, 10% of every dollar that walks through your front door goes to Hilton. Marriott's structure is similar. IHG charges comparable numbers depending on the brand tier. On a hotel generating $5 million in annual room revenue, that's $500,000 per year just for the right to use the name on the sign. Whether you had a great year or a terrible one. Whether occupancy was 85% or 55%. The brand fee is calculated on gross revenue, not profit. You could be losing money. Hilton still gets paid. Then the management company takes its cut. Most hotel owners, particularly investors and developers who built the property as a financial asset, do not run the hotel themselves. They hire a professional hotel management company to handle daily operations, staffing, guest services, revenue management, food and beverage, maintenance, the entire operational layer. That costs between 3 and 5% of total revenue, plus performance incentive fees that can add another 1 to 2% in a good year. Some contracts include base fees plus incentive structures that push total management costs higher. So now you're at 13 to 15% of gross revenue already consumed by brand fees and management fees before a single employee is paid. Then the booking platforms take their cut. In 2024, somewhere between 20 and 30% of hotel bookings in the United States came through online travel agencies. Booking.com, Expedia, Hotels.com, and their affiliated platforms. These OTAs charge commissions that have climbed significantly over the past decade. Rates that were historically around 10% have risen to 15 to 25% on standard bookings, and can reach 30% on promotional placements or last-minute inventory. Every guest who finds your hotel through Booking.com instead of your direct website costs you up to 30 cents on every dollar they spend. The brands fight this aggressively. Marriott Bonvoy has 237 million enrolled members. Hilton Honors has 215 million. The entire loyalty program infrastructure exists partly to push guests toward direct booking and away from OTA commissions. Book direct, get the best rate, is not just a marketing slogan. It's a financial survival strategy. But loyalty programs have their own costs. Points need to be funded. Redemptions eat into revenue. The average cost to the hotel of a loyalty point redemption is real money, and it compounds across millions of stays. Stack it all together. Brand fees at 10%, management fees at 4%, OTA commissions on 25% of your bookings, loyalty program costs, and then the operating expenses haven't even started yet. Labor is the single largest operating cost in the hotel business, and it has become significantly more expensive in recent years. Across the American hotel industry, labor typically accounts for 33 to 35% of total revenue. Housekeeping, front desk, maintenance, food service, security, management, A 150-room property running efficiently requires a staff of 40 to 60 people minimum, many of them working shifts that cover nights, weekends, and holidays year-round. In 2024, hotel labor costs rose 4.8% industry-wide, as wage inflation and staffing shortages pushed compensation higher across the board. In major cities with higher minimum wage requirements, California, New York, Washington State, labor costs run significantly above national averages. A full-service hotel in San Francisco or New York City can see labor consume 45% or more of total revenue. Insurance has become a separate crisis entirely. Hotel property insurance costs rose 17% in a single year in 2024, driven by climate risk repricing, litigation trends, and capacity leaving the market in certain high-risk states. Operators in Florida, Texas, and coastal markets have seen insurance costs that would have been unrecognizable 5 years ago. Utilities, property taxes, maintenance, and capital reserves, the ongoing cost of keeping a building in operating condition, typically add another 10 to 15% of revenue. Add it all up, brand fees, 10%. Management fees, 4%. Labor, 34%. Insurance, utilities, maintenance, 12%. OTA commissions on a portion of bookings, 4 to 6% effective rate. Property taxes and administrative costs, 4 to 5%. You are at 68 to 71% of gross revenue before debt service. The average net operating income margin for a U.S. hotel, after all operating expenses and before debt service, runs between 25 and 35% in a healthy year. And that sounds reasonable until you factor in the debt. Most hotel acquisitions are financed. A $36 million hotel purchase with 65% leverage means a $23 million loan. At 2024 commercial lending rates, which for hotel properties range from 6.5 to 8.5%, depending on the lender and the asset, annual debt service on that loan runs $1.8 to $2.2 million per year. After debt service, the net cash flow on a typical mid-scale hotel running well lands somewhere between 8 and 12% net margin. On $5 million in revenue, that's $400,000 to $600,000 in annual free cash flow. To recover a $15 million equity investment at that rate, setting aside appreciation and assuming nothing goes wrong, takes 25 to 35 years. And things go wrong. In 2020, American hotels lost $46 billion in room revenue compared to 2019. Occupancy rates fell to 44% nationally. In major urban markets, hotels that were running 85% occupancy in February 2019 were running 10% occupancy in April 2020. The brand still needed its fees. The management company still needed its fee. The debt still needed its service. The hotel owner needed to make payroll, pay the insurance, maintain the building, and keep the lights on, for a building generating almost no revenue. Several major hotel ownership companies filed for bankruptcy protection during this period. Extended Stay America restructured. Chesapeake Lodging Trust was acquired under distress. Numerous individual properties defaulted on their loans and were transferred to lenders. This is the risk profile that Wall Street analysts mean when they describe hotels as the most operationally complex asset class in real estate. Unlike an office building where tenants sign 10-year leases, or an apartment complex where rent arrives monthly, regardless of what the economy is doing, a hotel reprices its entire inventory every single night, every room, every day. Your revenue is entirely dependent on people choosing to travel, choosing your market, and choosing your property every night, indefinitely. A national recession doesn't reduce hotel revenue, it can eliminate it. And when revenue disappears, the fixed cost structure, the brand fees calculated on gross revenue, the loan payment, the insurance premium, the minimum staffing levels required to operate safely, those costs don't disappear with it. This is not a theoretical risk. It happened in 2001, after September 11th. It happened in 2008, during the financial crisis. It happened in 2020, on a scale that dwarfed anything the industry had previously experienced. The investors who survived those periods shared one characteristic. They had conservative leverage, significant cash reserves, and in most cases, multiple properties rather than one. Here is where the story changes direction. While hotel owners in 2024 were fighting over single-digit margins and negotiating PIP timelines with brand representatives, Marriott International reported $5.4 billion in gross fee revenue for the year. Not room revenue, not hotel revenue, fee revenue. The money Marriott collected from hotel owners, people like the hypothetical investor we've been following, for the right to operate under Marriott's brand system. Marriott owns almost no hotels. What Marriott owns is the brand, the loyalty program with 237 million members, the reservation technology platform, the training systems, the standards infrastructure, and the trust that causes a business traveler in a city they've never visited to book a Marriott property sight unseen. And for that system, for that name and that infrastructure, Marriott collects a percentage of every dollar every franchise property earns, whether that property is profitable or not. The owner has a bad quarter, Marriott still gets paid. There's a recession, Marriott still gets paid. The roof needs replacing, that's the owner's problem. This model is called asset light, and it has made Marriott, Hilton, and IHG among the most efficiently profitable companies in all of American business. Hilton's 10-year total shareholder return through 2024 has outperformed the S&P 500. The company carries minimal real estate on its balance sheet, generates fee income that scales automatically as franchised hotels grow their revenue, and has essentially zero exposure to the operational risks, the staffing crises, the insurance cost spikes, the PIP obligations that consume hotel owners every day. If you had taken the $15 million you were considering investing in a Hampton Inn and put it into Hilton stock 10 years ago, the comparison is not flattering to hotel ownership. The brand doesn't own the hotel. The brand owns the reason people book the hotel. And that turns out to be worth considerably more. And yet, people do make real money owning hotels. Significant, generational money. They just do it differently than you'd expect. The American mid-scale and economy hotel industry has been quietly dominated for decades by a specific immigrant community, Gujarati Indians, and disproportionately, families with the surname Patel own an estimated 60% of all economy and mid-scale hotel properties in the United States by count. The Asian American Hotel Owners Association estimates its members control hotel assets worth over $700 billion. This is not a stereotype. It's documented economic history with a specific origin point. The pattern traces to the 1970s, when early Gujarati immigrants discovered that small, independent American motels could be purchased at prices accessible to families pooling savings, and that by living on site and operating the property as a family unit, the economics transformed completely. No management company fee, no outside labor costs for positions family members could cover, no corporate overhead. The family lived in the building, answered the front desk, cleaned the rooms, handled maintenance. The cost structure that defeats outside investors, the 3 to 5% management fee, the labor cost at 34% of revenue, simply didn't exist in the same way. Profits were reinvested, not extracted. The first property generated savings for the second generated savings for the third. Each new property, once it reached sufficient scale, was franchised under a brand flag. Not because the brand was essential to operations, but because the brand's reservation system was a distribution tool. Access to Hilton's or Marriott's booking network for a family with proven operational efficiency is leverage. For an outside investor paying 4% management fees on top of 10% brand fees, it's a burden. The lesson isn't that you need to be from Gujarat to succeed in hotels. The lesson is structural. One hotel is a job. You are the operator, the risk bearer, and the maintenance department. 10 hotels is a business. The brand becomes a tool rather than a dependency. The operational systems become scalable. The overhead gets absorbed across a larger revenue base. The hotel industry rewards patience and scale in a way that punishes single property investors trying to extract returns from a building that has 3 other stakeholders ahead of them in line. Let's bring it back to where we started. You invest $15 million in a 100-room Hampton Inn. Annual revenue runs $3.5 to $4.5 million depending on your market and your performance. After brand fees, management costs, labor, insurance, maintenance, and debt service, you are looking at $200,000 to $450,000 in annual free cash flow in a good year. In 7 to 10 years, Hilton will send you another PIP. Budget $2 to $5 million for that. When you eventually sell, the buyer will immediately receive their own PIP, which suppresses what they're willing to pay because they're pricing in the renovation cost before they calculate what the property is worth to them. Meanwhile, Hilton, which collected 10% of your revenue every year, required the PIP that cost you millions and set the standards you operated under, reported record fee revenue in 2024, and is projecting continued growth in 2025. Their stock is up. Their pipeline of new franchised properties has never been larger. Their debt belongs to someone else. Their renovations are someone else's problem. Marriott doesn't own hotels. They own the name that makes someone in Chicago book a room in a city they've never been to. They own the app on 237 million phones. They own the points sitting in someone's account that will bring them back to a Marriott property, whether the underlying owner is having a good year or a terrible one. The building is yours. Everything that makes the building worth anything, that belongs to them. And the contract you signed the day you became a hotel owner is what makes that arrangement permanent for the duration of your ownership. One hotel is a building. The brand is the business. And understanding the difference between those two things is the only thing that separates the hotel owners who build real wealth from the ones who spend 30 years learning an expensive lesson about whose name is on the sign.